Hello everyone and welcome to today's webinar on strategic stop loss and take profit, mastering risk and reward. My name is Ali Mortazavi, the head of education here, and I'm thrilled to have you join us today. Before we dive into the core content, could I just get a quick confirmation from you all? Please type yes in the chat if my voice is clear and the videos is displaying correctly. So if anyone is experiencing any issues, please let us know now so we can address them as quickly as possible. I would appreciate your collaboration. Thank you. Excellent. So it looks like we're good to go. Today, we will explore the critical techniques and strategies behind setting effective stop loss and take profit orders. These tools are vital for managing risk and ensuring that your trading strategy delivers consistent results. We will cover the theory behind these concepts and provide practical tips that you can apply to enhance your trading decision. So let's get started with understanding the fundamentals of stop loss and take profit strategies. Before we begin, at Errante, we pride ourselves on being a premium online brokerage firm dedicated to forging lasting and trustworthy relationships with our clients and partners. And this webinar is brought to you by Errante. And please note that the information shared in today's webinar is intended solely for educational purposes. Please, it should not be construed as investment advice or trading signals. We encourage you to conduct your own analysis and consider your financial position before making any investment decision. Important to note, trading CFDs carries a significant level of risk, which may not be suitable for all investors. A considerable number of retail investors' accounts lose money when trading CFDs, so you should fully understand the risk involved and consider whether you are prepared to accept the high risk of losing your money. Today's insights are meant to enhance your understanding of trading strategies and to direct your trading actions. Okay, so we will delve into essential aspects of risk management and order execution in Forex trading. By the end of this session, you will be equipped with valuable insights to enhance your trading strategy and decision-making progress. Firstly, we will explore the significance of take profit and stop loss orders. These are fundamental tools used to manage risk and secure profits in foreign trading. We will discuss how these orders function to close open position at predetermined price levels, both in profit and loss scenarios. And then we will delve into the intricacies of setting stop loss orders effectively. Understanding four main methods for determining stop loss levels is crucial for mitigating risk and, let's say, protecting your capital. And we will examine various techniques that tailor stop loss orders to specific market conditions, trading styles, and individual risk tolerance. Moving forward, we will shed light on the concept of risk to reward ratio, and this pivotal metric measures the relationship between potential profit and potential loss in a trade. We will explore its definition, importance, and key considerations for maintaining a favorable risk to reward ratio in your trading endeavors. And additionally, we will explore strategies for setting take profit orders effectively. Choosing the right method entails a nuanced understanding of market dynamics, your trading style, and individual analysis. We will provide insights into selecting optimal take profit levels to capitalize on market movements while safeguarding gains. And for sure, lastly, we will open the floor for an interactive Q&A session. And this is your opportunity to seek clarification on any aspect of the MT4 platform or trading strategies discussed today. Your participation is highly encouraged, guys, as we aim to foster a collaborative learning environment and address any lingering doubts or inquiries. So prepare to embark on a journey of discovery and refinement as we navigate through these critical components of forex trading. So let's dive in and empower ourselves with the knowledge and skills necessary to success in this dynamic. Very well. So let's start by discussing the stop loss orders. These are critical for managing risk in trading. A stop loss order is an order placed with a broker to sell a security when it reaches a certain price, or let's say in better explanation, to close an open position when it reaches a certain price. As you can see in this example on the left, a stop loss order is set below the current market price for a long position to limit potential losses, and for short positions, it would be set above the current market price. And the key benefit of a stop loss order, as highlighted on the right, now I guess it appears, yes? Great. Uh, is to protect your capital. It helps to lock in your losses at a level that is acceptable to you, preventing any emotional decisions that might lead to greater losses. Essentially, it acts as a safety net, automatically activating when the market hits your predetermined price level. This automatic activation means that you don't have to monitor the market constantly. The stop loss order works as your, let's say, vigilant guard, stepping in to execute a trade when needed. Moving on to take profit orders. These are set to automatically close your position when the price of the asset reaches a level that realizes a desired profit, as shown in the graphical presentation for the order setup. This is particularly useful in securing profits before the market can reverse against your position. And indicated as indicated here, the main purpose of oh, okay, I think there's a delay between my presentation and my voice. Okay, let me ask my colleagues to fix it right away. Thank you for notifying me. Okay, I guess the issue just fixed, so let's continue. Okay, I was saying this type of order as a take profit is also automated, similar to the stop loss activating when your profit target is reached. So this automation is initial for helping traders avoid the common pitfall of greed, where one holds onto a position too long, hoping for an even higher profit, only to see the market move unfavorably. Now let's discuss the broader importance of both take profit and stop loss orders. They are fundamental to effective trade management. These tools help in managing your trades without the need for constant market surveillance. They also significantly reduce the emotional stress involved in trading by preventing rush decisions based on sudden market moves. Furthermore, these orders aid in strategy optimization. They ensure that your trading decisions are executed precisely at the levels you've deemed most strategic, thus allowing for better management of risk and potential profits. By using these orders strategically, you can maximize efficiency and effectiveness in your trading approach. I hope this overview clarifies how stop loss and take profit orders function and why they are, let's say, indispensable in trading. Are there any questions or points you'd like me to go over again or explain more details? Please just write it down through the chat box, then I will be more than happy to address that. Perfect, so let's continue. and delve into various methods for setting stop losses, which are critical for managing risk effectively in your trading strategy. Choosing the right method depends on your trading style, risk tolerance, and the specific characteristics of the market you are trading in. Today, we will explore four common methods: percentage based, geographical, technical, and volatility based stop losses. Let's break down each method with examples to help you understand how to apply them in real world scenarios. Then you will be able to choose which that suits you more. Okay. First up is the percentage based stop loss. This method involves setting your stop loss at a certain percentage of your trading account's balance. For example, if you have a $10,000 account and you decide to risk 2% on a trade, your stop loss would be set to protect $200 of that account. And this method is straightforward and helps maintain a consistent risk management strategy across various trades. Cool. Next, we have the geographical stop loss. This method uses key price points on a chart, such as support and resistance levels, to set stop losses. For instance, if using a moving average as a stop loss, you might set the stop loss order just below a moving average if you are in a long position. And if the price drops below this moving average, the stop loss triggers and closes the position, minimizing potential losses if the trend reverses. Yeah, now let's go through the third method, which is a technical stop loss. This involves using technical analysis tools like moving averages or trend lines. For example, if a price is hovering near a significant support level, you might place your stop loss just below this level. The rationale here is that if the support level is breached, it might signal a potential reversal, and thus exiting the position would protect you from larger losses. There is a let's say, there's a big change between the geographical stop loss and the technical stop loss. And the geographical stop loss, we usually rely on the price levels, okay, not indicators or uh, let's say analytical tools. But in technical stop loss, we mostly use those oscillators and indicators as a hint to find a pivotal point in a trend. So in that case, you might have seen that many times it happens that we need to combine all of these methods together to get a proper stop loss. A stop loss that can protect our positions, which is not too short or let's say too close to our entry, that any minor volatility in the market may just threaten our account, or not too far that can let our losses uh, go too far, and that in that case we might be able this very risky chance of blowing our account. With this explanation, let's jump on the last one. We have the volatility based stop loss, which uses market volatility to determine where to set the stop loss. A popular tool for this method is the average true range, or ATR, which measures the average market volatility over a specified period of time. Suppose the ATR is 100 pips, let's say, you might set your stop loss at 1.5 times the ATR, or 150 pips away from the current price or from your entry point. This method is particularly useful in highly volatile markets to avoid being stopped out prematurely by normal price fluctuations. So in that case, you see, we are not going to discuss how to set our stop loss first of all, because during this course we're gonna walk you through all the practical methods, but the important thing at the beginning is to understand the philosophy behind it, to understand the rationale behind it. So Each of these stop loss methods offers different advantages depending on your trading objectives and market conditions. By understanding and applying these methods wisely, you can enhance your trading strategies effectiveness and protect your capital as well. Now, let's take any questions you might have before we move on to take profit strategies. I hope everything to be clear so far. Very well. So let's move on. In this part of our discussion, we focus on the percentage-based stop loss method. This approach is determined by setting an acceptable loss amount based on a specific percentage of the total capital in a trader's account. It is a fundamental strategy used by traders to manage their risk effectively by defining in advance how much of their capital they are willing to risk on a single trade. So to effectively implement a percentage-based stop loss, there are a couple of crucial points to consider. First, understanding market conditions, including support and resistance levels, is essential. And this understanding helps in setting the stop losses at levels that respect market psychology and technical factors. Second, employing technical analysis to identify the best entry and exit points that can optimize this strategy. This involves analyzing market trends and price patterns and making informed decisions about where to set your stop loss, ensuring it aligns with both your risk tolerance and market dynamics. Now, let's look at the advantage of using a percentage-based stop loss. Firstly, it offers simple and direct control over risk level. By deciding on a specific percentage, you standardize the amount of risk across different trades, regardless of the underlying assets volatility or market conditions. Secondly, this method helps in the prevention of large and unexpected losses. By capping the risk per trade, you ensure that no single trade significantly harms your overall account balance. And lastly, it increases your chances for surviving in volatile markets. Since the stop loss is based on percentage of your account size, it adjusts with the scale of your trading account, allowing more flexibility and better risk management in markets that are prone to high fluctuations. So, implementing a percentage-based stop loss not only simplifies your risk management strategy, but also, let's say, fortifies your trading discipline. And by consistently applying this method, you can help ensure that sorry, you can help ensure that your trading decisions are both calculated and protective, even in unpredictable market conditions. So let's pause here for any question or comments before we proceed further. That'll be interesting to you if you know that this percentage based stop loss is the base or foundation of position sizing, the most common and proper way to, let's say, expose ourselves uh, to the markets using the position sizing that we could get through it later in this webinar for sure. Very well. Very well. Okay. Thank you so much for your confirmation, guys. So let's continue further. Now, uh, in our next focus, we explore the geographical stop loss, which is quite different from the percentage-based approach we discussed earlier. A geographical stop loss is set based on a specific percentage of the total capital in a trade's account, but it is also let's say, intricately linked to key price points within the market's geography, such as support and resistance levels. And this method hinges on the market's technical landscape, making it highly responsive to real-time market movements. To effectively leverage a geographical stop loss, there are two critical considerations. First, a deep understanding of technical analysis is essential here. This involves the ability to read and interpret charts to identify where support and resistance levels lie. Knowing these levels helps set more informed and strategically placed stop losses. Second, integrating this strategy with other risk management methods, such as percentage-based stops, I explained as the most common way, or volatility stops, can enhance your protection against unexpected market shifts, creating a robust trading plan. As we are going through all of these methods and explain them, please notice that it, it doesn't mean that you have to hire only one method and comply only with one way to set your stop loss, but instead you have to combine them together and use them based on the let's say uh, trading setup. For example, when you see you have a more shining and clear technical analysis, excuse me, you have a more clear technical analysis confirmation or hints to set your stop loss, you might rely on technical stop loss. And when you see the market is at a very extreme point of a support or resistance level, you can go for geographical stop loss. It means you can give it a more weight to consider it in your calculation. And at the end of the day, doesn't matter each method you're using. At the end of the day, the position sizing is vital to survive in the market that we will get through it later in this webinar. So uh, the advantages of using a geographical stop loss include its direct linkage to market conditions, which ensures that a stop loss adapts to changes in market dynamics, potentially offering greater protection and precision. For example, if you have a long position in Euro USD and there is a strong resistance level at 1.2, you might set your stop loss just below a recent support level at 1.185. Okay, this placement ensures that if this support level is breached, the stop loss can limit your losses before the price potentially falls further. Another key advantage is the increased likelihood of maintaining positions during minor fluctuations. For instance, if GBP USD moves towards a known resistance level and you anticipate a breakout, setting a stop loss just below a nearby support level can allow you to stay in the position longer, giving the trade a chance to profit if the breakout occurs. Finally, this method helps in the prevention of premature exits, which can occur if the stop loss is set without regard to the technical structures of the market. It helps in avoiding exits that are either too early, missing potential profits, or too late, incurring greater losses, as I explained. So this is the core meaning of a proper stop loss. Okay, so means the proper stop loss should help us to prevent of premature exits, which can occur if a stop loss is set without regard to technical structures of the market. So it helps in avoiding exits that are either too early, missing potential profits, or too late, incurring greater losses. That's why geographical stop loss strategies provide a dynamic way to manage trading risks tailored closely to market movements and technical indicators. By applying this method, traders can align their risk management more closely with their market analysis, leading to potentially more effective trading outcomes. Okay, let's take any questions you have at this point before we move on to more complex strategies. All clear? Very well. I'm really happy, guys, with your feedback. That's amazing. Thank you so much. Thank you, Mr. Ahmed, uh, Mr. Amir, Mr. Mohammed. Yeah, Mr. Johnny, and the rest of our very uh, very great attendees today. I'm getting a lot of energy from you guys. Thank you so much. Okay, let's move forward. In this section, we'll cover technical stop loss, a method that uses various technical indicators to determine the optimal placement of stop loss levels. This strategy is particularly effective because it aligns your stop loss decisions with the technical readings of the market, allowing for more data-driven approach to managing trading risks. To utilize the technical indicators effectively for stop loss setting, two main points should be emphasized. First, a thorough understanding of the functions and settings of the indicators used is crucial. Each indicator is a specific features and setting that needs to be mastered to optimize their use in setting stop losses. Second, it's important to adjust the stop loss based on market changes and price fluctuations. This means regularly updating your stop loss and align with new technical signals, ensuring that your risk management strategy remains relevant as market conditions evolve. Good. Okay, now let's explore some of the most commonly used indicators for setting technical stop losses. First, we have moving averages. The moving averages smooths out price data to create a single flowing line. You know that, which makes it easier to identify the overall direction of the price movement. For example, a trader might set a stop loss just below a 50-day moving average on the daily chart. And if the price falls below this average, it could indicate a potential downward trend, triggering the stop loss to protect against further losses. Another tool I can mention Bollinger Bands. These are statistical charts characterizing the prices and volatility over time of financial instrument. The common strategy is to set a stop loss near the lower Bollinger Band in a long position, which can act as a dynamic support level. If the price breaks below this band, it might suggest an unusual drop, justifying a stop to limit losses. And the next tool is RSI and also stochastic indicators. Both of these are momentum indicators. The relative strength index measures the speed and change of price movements, while the stochastic oscillator compares the closing price of a commodity to its price range over a given time span. For instance, if the RSI or stochastic indicators show overbought conditions, the stop loss might be tightened or moved to protect profits in anticipation of a potential price reversal. I would like to wrap up this slide with mentioning that using this technical indicator for setting a stop losses can significantly enhance your trading strategy by providing a data-backed basis for making decisions. It's essential to practice and become proficient with these tools to fully leverage their capabilities in live trading environments for sure. And you need to practice it, of course. And before that, you really need to enhance your knowledge about the rationale behind each indicator to make sure that you are using it in a proper way that can help your trading your trading to improve your trading actually. Okay, are there any specific questions about how to apply this indicator? Would anyone like further examples on using these tools in different market scenarios? I think for now you're cool. Okay, that's great. So let's move on. Of course, guys, we will walk through all the examples and don't get to rush. We will get to that point for sure. But before that, in this section, Let's explore the volatility-based stop loss method. Uh, this approach uses the extensive price fluctuations within a specific period of determined uh, uh, period of time, to determine an appropriate stop loss level by considering the natural market volatility. This method allows traders to set stop losses that are both adaptive and responsive to current market conditions, reducing the risk of being prematurely stopped out due to normal price movements. For effective use of volatility-based stop loss, consider the following key points. First, duration of ATR use. For short-term trades, utilizing a 40-day average through range or ATR is beneficial because it reflects the most recent market volatility, and this is a very common way to use that in this way. However, for positions held over a longer term, using an ATR with a longer duration may provide a better overview of market changes. And also, you can consider adjusting the ATR multiplier. Depending on market conditions and personal risk tolerance, the ATR multiplier can be adjusted. A higher multiplier might be used in more volatile markets to avoid being stopped out too early, while a lower multiplier could be suitable for less volatile conditions. Now, let's discuss the advantages of volatility-based stop loss. It includes adaptability to market conditions. This flexibility ensures that the stop loss is set in a way that is sensitive to recent price behavior and volatility rather than a fixed price point. Additionally, this method significantly reduces the likelihood of premature exits by accommodating price swings within the calculated range. Let's consider an example. I know it's getting a bit confusing. Okay, no problem. Don't worry. Suppose you're trading Euro USD and the current ATR is 50 pips. Deciding to set a stop loss at 1.5 times the ATR would means placing it 75 pips away from the entry point. This setting helps protect against normal fluctuations, giving the trade more room to breathe before deciding if the market trend will actually reverse or continue. So utilizing a volatility-based stop loss is especially powerful in highly fluid markets where traders need to dynamically adjust their strategies based on the current volatility. This approach not only safeguards investments, but also maximizes the potential for gains by preventing unnecessary exits. Now, as we transition from discussing stop loss strategies, let's focus on an equally crucial concept in Forex trading, the risk to reward ratio. This ratio is a fundamental aspect of successful trading strategies as it helps traders manage their profits in relation to potential losses. Okay. Mm, The risk to reward ratio compares the potential profit or reward of a trade to the accepted risk or stop loss that we set beforehand. It quantifies the expected return each dollar risked. It's really important to understand it this way because a favorable ratio means that the potential gains of a trade are reasonably higher than the risk involved. And that's the way to become a successful trader. But let's take a look at the calculation. To calculate the risk reward ratio, divide the potential profit by the potential loss. It's very simple. For example, if a trader expects to make 100 pips on a trade and sets a stop loss at 50 pips, the reward to risk ratio would be 2 to 1. This means for every pip risked, a trader expects to make 2 pips in return. Okay, so the importance of this ratio lies in its ability to help traders make sound investment decisions. A higher risk to reward ratio generally indicates more potential profit for each unit of risk, making this a crucial measure for evaluating trade viability. Effective use of this ratio can significantly affect a trader's ability to be profitable in the long term, as it ensures that potential rewards on trades consistently outweigh the risks. But please don't forget that for effective application, traders should aim for a risk to reward ratio of at least 2 to 1 in their trades, and this benchmark helps in maintaining a healthy balance between profitability and risk management. Precise management of this ratio is essential. It involves not only setting appropriate stop loss and take profit levels based on technical analysis and market conditions, but also adjusting them as the trade progresses to lock in profits and minimize losses. Adhering to a disciplined approach in maintaining this ratio can drastically reduce the impact of losses and enhance overall profitability. However, it totally depends on your trading strategy. It's not all about a higher reward to risk ratio. No, it doesn't work this way, guys, because the probability of getting the uh, fine results from your strategy is something very dependable to the level of the profit you set, which means, for example, if your strategy has the 70% chance of hitting your take profit at 1 to 1, for example, reward to risk ratio, if you just move further your TP, the chance of getting that new point is will be reduced. In that case, your chance per trade gonna decrease. So we don't want to let that happen to our trading system. That's why in our next sessions of our course, we're gonna discuss the trading plan. But right now, just consider that for each dollar you put at risk, you have to get a reasonable reward. Otherwise, it doesn't mean it's not good to enter the market. So understanding and applying the risk to reward ratio effectively can be a game changer in Forex trading. It's not just about limiting losses, but also about maximizing potential gains strategically. Now, as we shift our focus to setting take profit levels, it's crucial to recognize how these are uh, intrinsically linked to the risk to reward ratios we discussed earlier. Effective setting of take profit levels not only secures potential profits, but also ensures that these profits are proportional to the risk taken. Let's explore four primary methods to set take profit levels in Forex trading. It's suited to different trading strategies and market conditions, and you can choose between them or combine them based on your trading style or based on your personality, trading, your risk tolerance, and all the other factors included in making these financial decisions. First, fixed take profit. Starting with the fixed take profit, this method involves setting a take profit order at a predetermined number of pips from the entry points, regardless of the market conditions or price structure. For instance, a trader might always set a take profit of 50 pips on a particular currency pair. This method is simple and can be effective in markets with less volatility, where price movements are more predictable. But in overall, I don't recommend this because setting a take profit is really uh, depending on market condition. That's why we have to go through the second method, risk reward ratio based take profit. The next approach is based on the risk reward ratio. Here, the take profit level is determined as a multiple of the risk or stop loss set on the trade. For example, if a trader sets a stop loss at 25 pips, they might establish a take profit of 75 pips using a 3-to-1 reward to risk ratio. And this method ensures that the potential reward justifies the risk undertaken, aiming for a higher payoff on successful trades. And uh, it can be good, but by the way, you should have a good confirmation from the market analysis or from your trading setup on the chart that this gonna happen in the market. For example, when you see a very let's say considerable uh, amount of momentum in the market in your favorable direction, that's a good way to set uh, let's say uh, the risk reward ratio based take profit. However, uh, it's not just covered. So we need to go through the other methods, which is the market key points based take profit. This is a way you may let the market uh, somehow decide for us. Using support and resistance levels or trend lines to set take profit points is another strategic approach. For example, if trading a breakout, a trader might set a take profit just below a significant resistance level, where the price has previously shown a strong reaction. This method takes advantage of known market psychology and price points, aiming to capture profit before the market potentially reverses, because it doesn't matter what we want, the matter is what market does. So the other way that we can combine with this third one or the last one is the technical indicators based take profit. Lastly, setting take profit levels based on technical indicators such as moving averages or Fibonacci retracement levels offers a dynamic way to manage trades. For instance, setting a take profit where the price approaches the 100-day moving average can capitalize on standard market movements and indicator-based predictions. This method aligns with the overall market momentum and historical price behavior. So you see, the last two ways of setting take profit are somehow matched together. Each of these methods offers distinct advantages and can be tailored to fit different trading styles and market conditions. By integrating these strategies with a solid understanding of risk management, traders can optimize their profit-taking techniques to enhance their trading performance. Uh, so are there any questions on these methods, or would anyone like further clarification on how to apply these strategies in real-time trading? Okay, cool, very well. So, so I can make sure that you all understand the concepts. That's great. Perfect. Okay, guys, let's imagine you are in a trade that's performing well and you're watching your profits increase. You face a common dilemma. Should you exit now and secure your profits, or should you stay in the trade hoping the price will go even higher? Exiting too early might mean missing out on potential gains, but holding on too long could risk those hard-earned profits. This is where the strategy of partial take profits or PTP comes into play, offering a balanced solution. The partial take profit method involves closing a portion of your trading position at different profit levels. A common approach is to close 50% of the trade at the first profit target while letting the remainder of the position run to reach subsequent targets. This method allows traders to secure some profits early, reducing the psychological burden and financial risk while still maintaining the potential for additional gains. It effectively balances the risk and reward by ensuring that you lock in profits and stay in the game for possible further upward movements. Strategically, partial take profits are often set at key market points such as Fibonacci levels, resistances, or support levels. And these levels are typically where price reversals or significant breaks are likely to occur. Additionally, an important aspect of risk management with partial take profits is resetting the stop loss to the entry point after the first profit target is reached. This break-even stop technique ensures that whatever happens, the remainder of your position does not turn into a loss. So this is a very wise way to manage your open positions. To effectively use partial take profits, precise planning is essential. You need to predetermine the number of segments and the specific exit points for each segment before entering the trade. This preparation helps in executing the strategy smoothly and without emotional interference. Flexibility is also crucial. Being able to adapt to changing market conditions and adjust your take profit levels accordingly can significantly enhance your trading outcomes. So, a partial take profits is a sophisticated trading strategy that allows for flexibility in managing trades, securing profits while still offering exposure to potential further gains. It's a technique that can help resolve the trader's uh, dilemma of when to exit, providing a structured yet adaptable way to manage successful trades. As we conclude our webinar, let's focus on position sizing, a critical aspect that integrates all we have discussed about setting a stop loss and take profit. Position sizing is not just about determining how much to trade, it's about optimizing how we apply a stop loss and take profit setting to maximize profitability and manage risk effectively. Let's discuss position sizing in practice. Let's say position sizing involves setting a fixed percentage of risk per trade, typically 1% to 5% of your account's balance, depends on your risk tolerance. This careful calculation ensures that each trade is proportional to your trading capital, which helps in maintaining consistent risk management across all trades. Let's break down the steps involved in calculating position sizing. First, determine how much of your account you are willing to risk on a single trade. For instance, 2% of a $10,000 account is 200, let's say, dollars. This is a calculation of the amount at risk. And then we need to calculate, let's say, the PEEP risk or PEEP at risk. Calculate the distance in PEEPs from your entry point to your stop loss. This helps in quantifying the risk in terms of the market's price movements. Then we get to determining the monetary value of the position. Divide the amount at a risk by the PEEP at risk to get the monetary value of each PEEP movement. And then you can convert the position amount to lots. Finally, convert the total monetary value of the position into lots to understand how much volume you should be trading. It's very, very simple. However, let's consider an example with one with a 10K account where you decide to risk 2% and your stop loss is set at 50 pips. Okay, so as you see here, the account's balance is 10K, the risk percentage is 2%, the stop loss is 50 pips, and amount involved in the trade is $200 divided by 50 pips, which results in 40K. And if we want to get the lot size, we can just turn this volume into lots by dividing the 40K by one standard lot unit, which is 100,000 or 100K, which results in 0.4 lots. This calculation shows you should trade 0.4 lots to stay within your risk management parameters, which is the potential loss of $200. The beautiful of position sizing is that it incorporates the best practices of all other methods we have discussed for setting a stop loss and take profits, whether using fixed a risk reward ratio, market key points, or technical indicators based methods. Position sizing helps apply these strategies within the boundaries of calculated risk and potential reward. It ensures that every trade adheres to a disciplined financial strategy, balancing potential gains against acceptable losses. So position sizing is fundamentally about maximizing your trading effectiveness by optimizing your risk exposure and potential returns. It enables traders to systematically manage their trades and apply various stop loss and take profit settings in a way that aligns with their overall trading goals. I guess that's it for today, guys. Thank you all for joining today's webinar. It has been a pleasure to walk through strategic aspects of setting a stop loss and take profit levels, discussing position sizing and how these elements work together to enhance your trading decisions. We hope you've found the information valuable and feel more confident in applying these techniques to your own trading strategies. Now, when you look at the chart, you can decide based on the method, based on the setup of the chart, and based on your capital or risk tolerance, and you can combine all of these methods together to come up with a bit optimal, let's say, a risk management strategy. Please keep an eye out for our upcoming webinars where we'll explore more aspects of forex trading in depth, specifically a risk management, which we are in the course of risk management and forex trading. And your participation and engagement today have been greatly appreciated. If you have any further questions or need additional resources, please feel free to reach out. Wishing you success in your trading endeavors. Thank you once again and have a great day.